Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. And as always, we're joined by our two guests, Ashton as well as Henry Biddelcomb, both from Anchor Capital. Now today we talk about a tech giant now known as Alphabet, formerly known as Google, but now with different jurisdictions within which the company is looking to diversify its income. But to tell us all about this as well as the outlook for this particular investment stock, gentlemen, let's get your views firstly on identifying what Alphabet actually comprises of. I think initially when we heard about this change, a lot of investors were slightly cautious.
So it's still largely the Google search business. I think that's the first point to make. And effectively, they've created this split in reporting functionality to properly identify to investors what's going on ultimately. Now, I think ultimately what you're buying here is the titan of tech, a very high quality business with high operating margins, 25% plus operating margins, sustained strong revenue growth, pretty much dominant in the online advertising space, with a historically very strong growth rate. But I think there are some concerning signs on the horizon there, where they're starting to be competed against in the mobile ad space, principally via Facebook. And you're seeing that in the first quarter of this particular financial year, where their cost per click came down substantially. So they're starting to have to compete against a new competitor effectively in terms of online ads.
And if we do take a comparison between this company as well as some of the other tech giants, I think so often we refer to them as FANG stocks, the Facebooks, Amazons, Netflix and Google, if I'm not mistaken. How do they compare in size as well as competition? And Yahoo as well, which I think was one of the first ones onto the market space, but clearly dominated and surpassed by Google. Henry?
Well, Google is Alphabet is such an interesting one to talk about. I think it touches all of our lives on a daily basis. We all use their products. I mean, my email's on Gmail. I use Google Calendar, Google Maps, Google Earth, Google Drive, and really, it's become quite a mature platform that organizes your information, and it makes it universally accessible and useful. And it's not just the product set that's starting to mature, it's actually the underlying business as well. And we saw that last year when the company underwent a major restructuring and Alphabet replaced Google as the listed entity. And as Sean said, really what Alphabet has become is a holding company for the traditional Google search business, but also for the next generation ventures that they're investing in, where they believe the next wave could come. Now you've got a guy named Sundar Pichai, who's a 12-year company veteran who's heading up the traditional Google advertising business. And then you've got, on the other end of the spectrum, the billionaire brainiac founders, Sergey Brin and Larry Page. And they're not company men, they're innovators. And their job now is to go and find the next big thing for Google. But this creates somewhat of a dichotomy for investors, because on the one end of the spectrum, you've got a mature business that needs to grow, and you need to control efficiencies. And on the other end of the spectrum, you've essentially got a venture capital operation, and that can burn as much cash as you throw at it, and it can be unprofitable for long periods of time. So to bring the two together, what the board has done is they've appointed Ruth Porat, who is in fact the ex-chief financial officer of one of the world's biggest investment banks, Morgan Stanley, on board, to try and strike a balance between the two. Now it seems like she's quite highly regarded in the market. The first time the company reported with her on board was in the second quarter of last year, and she came to market with her sort of brainchild, which was segmental reporting. And you actually saw at that stage the share enjoy somewhat of a re-rating. It traded up from about $500 to $700, and that's because investors value transparency, and demonstrable, measurable financial discipline creates a quality company, doesn't it?
Precisely. Yeah. And if we do take a look at a chart that briefly came up just a moment ago with regard to that re-rating in the share price, how does this compare to the compounded annual growth rate? I understand the 3-year close versus the 12-month forward PE. Was there a particular readjustment that took place there, especially where we see the post-Q1 2016?
So I think from a valuation point of view, it's largely been delivered through earnings growth. If you look at the growth in the share price over time, if that's what you're referring to, and the valuation from a P multiple perspective is not materially higher than its long-term average if you take certainly 3 to 4 years worth of history. Post their first quarter numbers, the share price has come off somewhat. It's about 8% down on its Q1 figures, so it's probably a forward 20 P now, which is not as expensive as it has been in the past in terms of peak ratings. But I think what everyone was concerned about in this particular result was that you've had you've had ad volumes growing substantially. They had about 29% growth in paid clicks, but cost per click is down by 9%. And that's an active decision on the part of management to actually discount their fees in the face of higher competition coming through in the mobile ad space. And that's principally really Facebook.
Is that sustainable though in the long term?
Is what sustainable? The discounting?
The discounting.
Well, to the extent that you're still getting the volume growth, yes. So as long as you're getting volume growth of advertising spend, that's fine, because you don't bank price, or you don't bank volumes. You bank revenue ultimately. So as long as the interplay between those two results in higher revenue growth, that's fine. But I think what we need to be very wary of is if this discounting trend continues and the volumes slow down, then you've got a business that's under structural threat. So it's a trend that we need to watch quite closely. Facebook is obviously making quite big inroads into the mobile advertising space. And that's really Google's heartland, if you look at it historically, what they've made money out of in their search business.
Mm-hmm. If we do take a look at the in-network ads, though, I understand that this is where the sales mix is shifting towards. When we talk about in-network, is this the constant ads that we see when one logs onto YouTube and you try to click to skip them?
Absolutely. So and on the Google search engine as well. And that's obviously higher margin in nature. That's now 80% of ads versus 77% in the first quarter of last year. So you've actually seen operating margins being maintained despite the fact that you've had this pricing reduction that they've put through in the online advertising space, which is a good thing. Mm-hmm. But I think the market's been somewhat concerned about the potential threat of the advertising business from the likes of Facebook.
Mm-hmm. How confident then should we be about the excess cash flow regarding these earnings that is coming in, going into these new investments, which for the moment are still not even in the infancy stage, but rather still inception and trying to capture the market?
I think
with new ideas.
What's quite encouraging to me is that scale is everything in this game. And here you've got a business which is making $5.5 billion worth of free cash flow quarterly. Mm-hmm. It allows them the opportunity to go and hire thousands of software engineers to throw money at the problem ultimately. Mm. I think if you don't have scale in this space, it's very easy for a new competitor to come and eat your lunch. But once you kind of own the eyeballs and you've got that cash flow that's coming through, you can invest in the next big thing. So it's important that they do innovate. I think the biggest thing I'd be concerned to watch out for is if I suddenly stopped becoming a Google user and I did my search via Facebook, for example. That to me would create a real problem for the likes of Google, but I don't envisage that personally becoming an issue anytime soon.
Mm-hmm. Regarding the revenue split, are we still happy with that? Because I do see the UK representing about 10%. Does the referendum coming up in June play any influence as to how that might impact on growth opportunities for the company?
Well, look, I think it's largely a function of what the currency does. If you look at what the currency's done to Google revenues in the first quarter of 2016, it's impacted them by a magnitude of about 6%. So, in as much as revenue disappointed, I think the market was expecting 20.3 billion and they delivered 20.2. It was a mild miss. You need to look at the underlying momentum of the business. Now, on a constant currency basis, they delivered 23% in year-on-year revenue growth. In actual growth, it was 17%. So, certainly dollar strength has been a headwind for them. But once that starts to normalize, I think you've got a business that's got some good, solid revenue growth momentum behind it.
Mm-hmm. I do understand that innovation, as you did mention a moment ago, does play an important part here, but would devices ever be a significant investment opportunity for the company? I can't recall which company it was that bought Motorola a few years ago.
It was Google.
Exactly,
yeah.
And that didn't go too well, if I'm not mistaken. So we're not looking at them to perhaps try and compete with some of their players in the game here that already produce the Android devices, that they have their software downloaded onto already?
You know what, Gugu, it is core to their strategy, but it's not going to be a profit maker for them. So what Google want is for you to log on and to log on onto and use their ecosystem, which is Android and which is Chrome on the PC side of it. So what Motorola was really about buying a manufacturer and developing a cell phone that they could use as a sort of a benchmark. And hopefully the rest of the industry would then pick up on that and they would start developing their own Android phones, which in fact happened. If you have a look at the likes of Huawei and Samsung now, yes. I mean, they're the biggest competitor to Apple and iOS. So Google will, to answer your question, Google will never be a hardware company. They will always be an ecosystem company and a services company, but naturally there need to be hardware synergies and it will always be part of their strategy, but never a significant part of their top or bottom line.
time now to get our views from our experts with regard to Alphabet, whether to buy, hold or sell the stock. Sean, let's start off with you. Are you keen on picking up Alphabet at these levels?
So I think at this level in the tech space, it's almost a value play. It's quite unusual to talk about a company at a forward 20p as a value player, but certainly relative to their peers and where they're trading, it's amongst the cheapest. And I think there's a fair amount of bad news in the price. I still think this is a business that can sustain 15% earnings growth, but there are some issues that we need to keep an eye on. This issue of volume growth of ads versus pricing reductions. We need to see that balance is maintained and that they don't become unseated by the likes of the Facebooks of the world. But I think for now at this level, with the earnings outlook that we have, I would say that it's a buy for me.
Buy for Sean. For you, Henry?
Well, Google.
That happens often,
you can
but it's
understand
okay.
why I get confused. With a stock like Google, I think a market overreaction to a mild earnings miss is always a buying opportunity. And for me, the market's put the stock on sale. So on a forward multiple of 20 with prospective earnings growth of around 16% for the next 3 years, certainly I think it's a buy.
Fantastic. Well, we'll leave it there for tonight. Clearly, our ABCs are getting a buy for this evening. That's the company Alphabet, holding company of Google. That's how we wrap up things for today's show. A big thank you once more to both my guests, Sean Ashton and Henry Biddelcomb, both from Anchor Capital. Join us again next time where we talk more stocks.